welcome back to another lesson, traders. Congratulations if you've made it this far in the course. This is lesson 8 and we're going to talk about another very important topic, and that is risk management and risk tolerance. So let's get into it. So risk management and risk tolerance, you'll hear this a lot when it comes to trading, when it comes to investing, when it comes to many things incorporating money. So what is it about these two? Well, losing or taking losses in trading is inevitable. It is as much a part of trading as is winning. Therefore, any trader that intends to take a trade must be aware of the risk involved and also how to manage the risk of loss. So that brings us to risk management. This is a crucial aspect of trading that helps traders minimize losses and protect their accounts from losing all their capital. It's an essential prerequisite for proper active trading and fundamental to long-term survival. To adequately manage risk, traders must first understand their risk tolerance, and that is how much money they want to risk per trade. So let's go over what risk tolerance involves. This is a personal decision. However, with newer traders, as they're still learning, it's better to start small and increase the risk with confidence and demonstrated consistency. Usually, risking 1% of the account value per trade is a good starting point. Secondly, after deciding their personal risk tolerance, traders can manage risk by using various techniques such as stop-loss orders, profit taking, as well as position sizing. And lastly, by planning trades with these in mind and having a strategic and objective approach, traders can prevent losses from getting out of control and again, protecting their capital, which is essential to long-term survival. And this is why risk management is so important, because it allows traders to open themselves up to making money in the market while minimizing and containing losses. Another important topic after understanding risk management is understanding the risk-reward relationship. Trading is a business of probability and numbers. In that regard, traders must take into consideration how much they're willing to risk, we just covered that, risk tolerance, versus the expected reward. We're in this game to make a profit. This is called the risk to reward ratio, or RR, and is often one of the most important decisions a trader must make in building the trading plan. Being that trades and instruments are not created equal, this RR decision has a great influence on the profitability of the trade. This analysis applies to all trades on all time frames. So traders often measure these in units, that is, units of risk to units of reward. For example, if a trader decides to risk $100 per trade, 1 unit of risk will equal to $100 as well. And they will measure the reward or profit by the same unit. Hence, if the trader achieves a $300 profit from the trade, they would have made 3 units of reward to 1 unit of risk. In this example, the trader would have achieved a risk-reward ratio of 1:3, a relatively good ratio to have as a trader, especially a day trader. So with this in mind, if the expected reward is less than 1 unit of risk, how long can the trader stay solvent? This is an important question that every trader must address. The lower the risk reward, the harder it becomes for the trader to sustain profitability and to even become profitable, as they must now greatly improve their win-loss ratio, which is wins to losses. Some of the most successful traders have a win-loss ratio between 60 to 70%. And it will likely be a lot lower, especially if you're just starting out. So a trading plan and system with an expected reward of greater than 1 unit of risk and a probability of winning greater than 50% has what we call a positive expectancy. And this is something that all traders should strive to have and continue to improve on. You want to ensure that your system has a positive expectancy, which means that it is paying out more than it is giving back to the market. So now let's move on to the next topic. Accepting risk and dealing with losses. A clear distinction between the professional trader and others is the way the professional accepts losses. No one can avoid them, and the acceptance of a loss is part of the trading way. When planning for the trade, the professional will always first plan the level of risk and the projected losing scenario or scenarios. So let's now talk about the novice versus the professional trader when it comes to losses and dealing with losses. A novice trader will often ignore stop losses, trade without a planned trade idea, and will have a problem coping with a small loss which can fast turn into an account crippling loss. Long-term survival again must be the goal of any new and experienced trader alike. It's always about making it to the next trading day. The professional trader accepts the loss before entering the trade. It becomes transactional for them. For example, when you go to buy a meal, you know it costs $5 and have accepted that you will spend $5 for that meal. Do you feel sad after purchasing the meal? No, because you planned that $5 to be taken out of your bank account in exchange for the purchase. In a similar way, the professional trader is okay with possibly losing the trade because they know that the risk on the table is the price they pay in exchange for the chance of a larger profit or the benefit of having that meal. So by planning and accepting risk, this will allow the learning curve to kick in. Just like professional traders, they plan, accept the risk, and then let the chips fall where they may. And this leads to the accumulation of capital, which is an essential tool when making increased profits over time. Again, trading is a business, and this is the goal of the trading business as much as any other business. And that's all for this lesson, traders. Thank you for tuning in. Looking forward to seeing you in the next lesson. Take care and bye for now.